The market just received the kind of inflation headline investors wanted. Consumer prices fell in June, core inflation stopped rising, bond yields eased, and growth stocks caught a bid. But that does not mean the inflation problem is solved. The next test is producer prices, because the market now has to decide whether the CPI relief was a durable shift or a temporary energy-driven pause. For investors holding technology, AI, or crypto exposure, that distinction directly affects valuation risk, momentum, and the probability that today's rally survives the next session. The starting point matters. Headline CPI fell 0.4% in June, while core CPI was flat. But energy prices were the largest force pulling the headline number lower. At the same time, oil has climbed back into the mid-80s, and the previous PPI report showed producer prices rising sharply. That creates a clean contradiction. Consumers saw relief in June, while the cost pressure facing producers may still be unstable. So the main variable is not simply whether PPI is good or bad. The real variable is whether the PPI result changes the direction of Treasury yields, the dollar, and liquidity-sensitive assets after the release. A number can look friendly in isolation, but if yields rise and the dollar strengthens, the market is telling you that the headline did not improve financial conditions. The same logic works in reverse. An uncomfortable number can be absorbed if the bond and currency markets refuse to tighten. In the base case, PPI lands close enough to expectations that it does not overturn the softer CPI message, but it also does not fully confirm it. Yields stay contained rather than collapsing. The dollar remains mixed, and technology shares hold most of their gains without broad acceleration. Bitcoin may stay firm, but not deliver a decisive liquidity signal. That would leave the market in relief mode, not confirmation mode. In the bull case, producer inflation comes in softer than expected, and the cross-asset response agrees. The two-year yield falls, the dollar weakens, and the rally broadens beyond a handful of AI leaders. ASML's strong results would then have a more supportive macro backdrop because lower discount rate pressure allows investors to pay more attention to earnings and capacity growth. Bitcoin holding or moving higher would add another sign that risk appetite is improving rather than merely rotating. In the bear case, PPI runs hotter than expected or exposes persistent pressure beneath the headline. If oil remains elevated, yields rise, and the dollar strengthens, the CPI rally can reverse quickly. High-duration technology stocks would be especially vulnerable because strong earnings do not protect valuations from a higher discount rate. Bitcoin could also fail to hold its bounce if liquidity conditions tighten across markets. The variable that changes everything is the bond market's reaction. A soft PPI print, followed by higher yields, would be a warning that investors are focused on oil, Fed communication, or another inflation component. A hot PPI print, followed by stable or falling yields, would suggest the bad news was already priced. The number starts the story, but yields tell you whether the story matters. This model cannot predict the exact market move, and it cannot isolate every headline arriving in the same session. Fed testimony, the beige book, earnings calls, and geopolitical developments can all alter the path. That is why the three scenarios use the same baseline and judge confirmation through several markets rather than one price candle. The practical framework is simple. First, compare PPI with expectations. Second, watch the two-year yield and the dollar. Third, check whether Nasdaq strength broadens, whether ASML keeps its earnings gain, and whether Bitcoin confirms or rejects the risk-on move. When these signals agree, confidence rises. When they conflict, the correct response is patience. The calm verdict is that CPI created permission for markets to rally, but not proof that liquidity conditions have turned decisively easier. Producer prices, oil, yields, and the dollar still have to confirm the message. Price is the surface. The cross-asset response is the evidence.